My name is Bonny Gilbert, and I'm with Fairway Independent Mortgage Company. So we are number 2 for reverse mortgages for purchases in the country. We're number 8 for reverse mortgages generally. So we do work throughout the whole country. And I will explain that a little better in another minute. We also do traditional lending, but I specialize only in reverse mortgages. So I have 15 years experience in mortgage industry and the finance industry. I am also an attorney. I don't practice anymore, so don't come to me with your legal questions. All of my jobs in the past, I also used to be a stockbroker, so all of my work has been finance related or counseling related or criminal law related, but we don't have to talk about that. So, all right. You don't need to see all these different articles. I have some of them for you all in a folder that I will give you later. It's just to let you know that the press is showing that there's been a real shift in reverse mortgages, the way they're perceived, the way that they are used in the last really about 7 years or so. Okay, and everything that I'm going to talk to you about is not my ideas. They're not my ideas. They're not my company's ideas. They really come from some of the top economists and economic programs in the country. And I don't know if any of you know like Harold Devansky or Robert Merton. Boston College of Retirement Research writes a lot about reverse mortgages. So it's those ideas and that information that I'm really presenting primarily today, and background information, of course, from FHA. All right, so Wade Pfau, who's a professor of retirement income, says, use strategically, a reverse mortgage can greatly improve the sustainability of retirement income. So what does that all mean? Well, that's what we're going to talk about, ultimately. But first, what I'd like to do is I want to make sure that I address any questions or concerns that you guys are sitting here with. So I'm just reaching for my pen. So I want to write down, what do you really want to find out? I mean, what are your any concerns that you have about reverses? There's been a lot of bad rap on reverses. So do you have anything in particular that you want to make sure I cover or that you have questions about?
I have a couple of questions. I thought you'd probably answer them as we get going here. But my questions are, first, can a reverse mortgage be applied to a vacation property?
Okay.
And second, can a reverse mortgage, excuse me, be applied to a mobile home?
Okay. Okay.
Those are my just specific questions.
Okay, and we will get to both of them, but I'm glad to know specifically. Renee, I'm skipping you because I know that you will just jump right in. Is that okay? Renee and I have spoken about this before.
If I want to move into a retirement home and keep my own home for a time period, do I get a regular mortgage or a reverse mortgage?
Okay, well, I'll make sure then to address that question.
No specific question.
No negatives about it that you want to see if they're true or bad or true or not true? No?
It's supposed to be fixed in recent years. I do
the patterns, yes.
I do hear that there's quite a difference between different people giving mortgages and the fees attached and things like that.
Okay, we will talk about all of that. Okay, swell.
Yes, that'll be important to me too.
You know what? Actually, the first thing I talk about are costs, because I know it's on everybody's minds, and I don't know what I just realized. Okay, so I used to save that for later, and I realized everyone's thinking about it, so why not just address it and get it out of the way? Okay, moving on. All right, so this is what we're going to do. We're going to talk about what is a reverse mortgage, why does the federal government support them, provide the program, how do they work, and then there's a whole bunch of different ways to use a reverse mortgage for cash flow, to buy a home, as a financial planning tool, for long-term care, for giving gifts to your children or making donations, things to think about if you're getting divorced or to prepare for widowhood. So those are things that we're going to touch on, but we only have an hour, so I just want to bring those things up and let you know. Okay, so basics. See, costs and obligations. Costs, like I say, everybody, even if they don't want to say it, they're thinking about the costs. And so I like to get it out of the way. All right. A reverse mortgage does cost more than a traditional mortgage. There are very specific reasons why, and I'm going to explain exactly that. All right, so first, in the first bucket, so basically closing costs come in 3 buckets, okay? There's 2 buckets for a traditional mortgage, and there's an extra bucket for a reverse, okay? So the first bucket is all of your traditional closing costs, okay? And that is, there we go, your appraisal. That's going to be the same as it would for any mortgage. The recording fees, the title search, all of those things, these are all the same costs that you have on any mortgage, okay? And they generally run somewhere between $2,500 and $4,000, really depending on the home, okay? And the size of the loan. It has nothing to do with the type of mortgage that you're getting, and none of these dollars goes to the lender. They all go to the service provider, right? And that's why they're the same.
Why does the size of the loan make a difference?
Because for instance, if it's a jumbo loan, okay, you may be required to have 2 appraisals, okay? So you'll be charged for 2. You know, for homes that are a couple $1 million or multifamily homes, those appraisals also, appraisers charge more for those. Title insurance is going to be dependent on the loan amount. So those are all things that are affected by the property or the loan amount that have nothing to do with the lender, okay? Then you have your origination fee. That is the money that goes directly to the lender, okay? And on a traditional mortgage, they range anywhere typically from like $1,000 to $1,800. That is what the lender is getting from you to do the loan. And that's called, so that's your origination fee, and that also can be discussed with the lender. Now that is more money on a reverse mortgage, okay? FHA puts a cap on the maximum that a lender can charge on an origination fee. And they use a formula depending on the appraised value of the home as to how much the lender can charge. The absolute maximum that a lender can charge is $6,000, but that is also something that can be negotiated with the lender. And typically, I think usually you're going to see more like $2,500 to $3,500 for the origination fee. So is that more expensive than a traditional mortgage? Yes. But that's only like $1,000 more in the greater scheme of things. That's not what makes a reverse mortgage so expensive.
Are points, what you know, when people talk about points, is that in there?
No, not necessarily,
Okay.
because when you're negotiating, it may or may not be interest rate related.
Okay.
Okay. The last one, upfront mortgage insurance. We are going to spend a good amount of time talking about what the mortgage insurance is and what that all means for a reverse mortgage. It is what makes the reverse mortgage program work, the FHA reverse program work. It's very important to protect not only the lender, but actually also the borrower's estate and their children, but it is expensive. And this is what makes a reverse mortgage so expensive. Okay? It's the one fee. It does not go to the lender. It does not go to other service providers. It's going to FHA, and it is what provides the program. And that is 2% of the appraised value of the home, capped at, this says $14,500. I just realized just now it hasn't been updated. They increased the amount of the value of the home that they'll use. I know you don't know what I just meant by that.
Now that's only in reverse mortgage.
That's only on reverse mortgages. But it's capped at like $15,000. FHA does have upfront mortgage insurance premiums on all of their mortgages, including traditional mortgages, but only FHA. Okay, so FHA does have this upfront mortgage insurance premium on all of their mortgages, but unless you're doing an FHA traditional mortgage, it doesn't apply to other traditional mortgages. Does that make sense? Is that clear? Okay.
Are you implying that the it's different if it's, I mean, I view the FHA as a government organization, but do they also give out reverse mortgages?
FHA, yes.
And so does that make a difference whether you get it from them or somebody else?
So here's the thing. FHA provides insurance for both traditional mortgages and reverse mortgages. They provide the guidelines on their traditional mortgages and on the reverse mortgages. It's really, in that way, both traditional and reverse, a government-sponsored program, but they don't actually lend any money. It's a program that the lender provides to the borrower, but it is backed by FHA and HUD. Okay, and we're going to talk more about that in a second, but FHA has been doing that, both traditional and reverses, for 30 years. You know, so like if you if you get a loan, a mortgage, and someone says, oh, it's Fannie Mae, Freddie Mac, and there's also a FHA. Does that make sense?
So they provide insurance.
Yes, and that's what this is paying for.
They don't. All right.
But they also provide the guidelines.
Yeah.
And so it's not, they won't just give insurance on any loan.
But they
It has
don't
to be-
do the actual loan.
They don't do the actual loan. But what we're going to talk about today is only the FHA product. Okay, because it's only the FHA product that has a number of benefits and that also has the insurance. And there are what are called jumbos, proprietary jumbos, meaning private company jumbos. They only became available in Massachusetts about 3 months ago. I'm happy to talk about them as well at another time, but if you understand how the FHA product works, then you will have a much easier time understanding those as well.
What makes it a jumbo? How much?
So in that case, it's not really about the loan amount, it's more about the value of the home. You want to look at a jumbo or the proprietary product if your home is worth more than 1.2 million.
Really?
Yes. Okay. Then it's worth looking at the jumbo as well, or sometimes it's worth looking at for condos.
And jumbo means,
Really, when a home, in this case, for reverses, we're really talking about homes that have a market value greater than 1.2 million. In the traditional world, it's talking about loan amounts that are greater than 600,000, basically. I mean, 6, 7, it depends on where you live, but basically it's like 600,000.
Why do these fees depend upon market value appraisal as opposed to the amount of money you want in the loan?
Well, you will see why on that in just a moment. So when you talk about it for traditional mortgages, that's a separate conversation, but I will explain to you exactly why it impacts it on reverses in just a second. And if I don't, let me know, I'll come back. Okay, so these are the obligations of someone who takes a reverse mortgage. You must pay your property taxes and you must pay them on time. You must keep a homeowner's policy on the home, and it has to be for a certain minimum amount, and it has to also not expire. You must keep the house in basically a safe, maintained condition. Right? And then you must use the house as your primary residence for 6 months and a day out of the year. So this is kind of going to your question.
now this is for a reverse mortgage?
This is only for, yes, this is reverse. I'm
but
only
not for
talking about
regular
reverse.
mortgage.
I'm not going to say another word about traditional, well, that's not true. I'm not going to talk much about traditional mortgages. This is all about reverses, okay? In order to qualify, or in order to keep a reverse mortgage, in order to have a reverse mortgage in good standing, these are the things you must do. Well, feel free to come in. Is it about the reverse mortgages?
Yes.
Yes, come on in.
Okay, thank you.
You're welcome, have a seat. We just kind of got started. We've already talked about costs, so if you have questions about that, I'll answer that later. We're talking right now about the obligations of a borrower. Okay, so property taxes, you must pay them. You must keep the property insured. You have to keep the home in a good, safe condition, and you have to use that home as your primary residence at the majority of time, so generally 6 months and a day out of the year. If you have more than 2 residents though, then it's, if you have 3, it's more than a third of the time. It doesn't always have to be the whole 6 months, all right? The other thing you must do before you can close on a reverse mortgage, or before you can even get an appraisal order, you sign a big old application that we can talk about later, and you also must meet one time with a counselor that is HUD approved or FHA approved. And what they're going to do is charge you $150, and they're going to make sure that you understand your obligations that we just talked about, that you understand when the loan comes due. We're going to talk about that in a second. And they also want to make sure that the borrower, because we are talking about an older population, that the borrower does, is mentally competent, or if they have someone with the power of attorney, that they understand all of this. And they also want to make sure that no one's being coerced into doing this, and not so much by the lender, but sometimes family members see an opportunity, to get the inheritance early. And sometimes there's a good reason to do that, but not always. They want the borrower to know exactly what's going on. So you must have this session with a counselor in Massachusetts, and in Massachusetts it has to be face to face. All right, and we give a list of everyone there is and blah blah blah. But okay, so when does the loan come due? It comes due so you can have two borrowers. So you could even have more than two borrowers. Let's say you have a child who's over 62 as well. Okay, so it could be all three, the parents and the child. But when all of the borrowers have stopped using the home as their primary residence, that's when the loan comes due. So typically, it's when the last borrower has died, or you always have the right to sell the home. So let's say you've sold it, that's when the loan comes due, just like a traditional mortgage. And also, I have a summary of this stuff too to give to you guys as well. So, so I can always give you some of the basics. All right. When you've moved out permanently without having sold, so for instance, you go into a nursing home, or you go into a rehab for a period of time, if you're out of the home, if you are not going to be returning to the home and you are out for a full year, then the loan can come due. Now, I shouldn't have said rehab in that. If the plan is you're going to come back and you've just been out for a year, but the doctor says, no, we do expect you to still be able to return to your home, then a medical letter will stop the loan from coming due. But if you're not expecting to return home and you know you're not going to, after 12 months of being out of the home, the loan will come due. All right? Or if you don't pay your taxes on your property insurance, it's going to come due really fast. So that's what happens to trigger the loan coming due. Any questions so far on anything that I've covered? Okay.
Bonnie, if for estate planning purposes, if you want to put your house in a trust, what happens with the reverse mortgage?
So it's exactly the same in that you can definitely have a property that's in a trust. We have to see the trust before we can close and make sure that the language allows you to have a mortgage.
Okay.
And as long as the language is there, and if it's not, a lot of times, depending upon the type of trust, it can be amended. Yeah, there are ways to address a trust, but a trust does not prevent a reverse mortgage.
Okay.
Necessarily.
Thank you.
You're welcome. Okay. So one of the things that I think people think about when they hear all about a reverse mortgage, and especially when you hear about some of the other benefits, is they think, oh, this sounds too good to be true. There has got to be a catch. Why does this, why is this so good? Well, there's actually some very good reasons why the reverse mortgage exists and why it has a number of the benefits that it has. This is the key thing to know. 10,000 people a day are turning 62 for the next 20 years. Actually, I think this slide's about 2 years old. Yeah, it's 3 years old. So for the next 17 years. And 3,000 of those 10,000 are still making mortgage payments. It's the fastest growing population in the United States. And what is the problem? People don't have enough money to retire. Generally speaking, most people are going to run out of money before they die. And the federal government knows this. This is not a secret. And we all know it because interest rates have been low, so retirement funds have grown at a slower rate. Healthcare costs have been higher than people have expected. Home costs have been higher than people have expected. And people are living longer. So the money has to last a lot longer. So, what are the things that the government could do about it? They could increase Social Security payments. Not that likely. They could build a lot more affordable housing. Not happening yet. Instead, what they've decided to do is, and this number also, got to get a new slide on this. This says $6 trillion is tied up in the home equity in the homes of people who are over 62. Now that number is actually over $7 trillion, and you can see that that is more money than what's in 401ks. It's almost as much money as in IRAs. That's a lot of money that people are basically, or literally, not literally, but figuratively sitting on in their house. And that is money that by providing the reverse mortgage and making it an easy loan for people to get, relatively easy, it used to be too easy and that actually caused some problems, but making it relatively easy for people to tap into that equity, it saves all these other, it saves basically the federal government from having to do all this other work on all these other programs, right? Where are people supposed to live? How are people supposed to afford their bills? Well, let's just let them tap into the equity that they already have built up over time. So that is the background thinking on how the reverse mortgage came about. And I'm going to just show you, I love to do this, okay? So humor me, yes.
Is there a fixed length of the loan, or it's until death or a default of some sort? And is there any penalty if you pay it off early?
No penalties for paying it off early, and it does not come due until you are out of the home for any of those 4 reasons that I cited earlier. So if it's 30 years before it comes due, it's 30 years. If it's 8 years, it's 8 years. And that's why the insurance policy is so important. Okay, and I'm going to explain how this insurance policy works, but that's why it's expensive. That's why it's so important, because it's what's protecting everyone, because who knows when the loan is going to come due? Who knows what your house is going to be worth at that time? Who knows how big the loan is going to be? I'm going to explain all of that in more detail in a second. But here's this thing, and I'm going to do this just because I enjoy it. But so you have your 3 buckets. You have your, when you're working, you have your money that you're putting into your Social Security and stuff, right? So we'll put some money in Social Security, and if you're contributing to pension and stuff, and then you have your other retirement funds that you're putting money in, right? Okay, so you're saving, you're being good, and you're saving money for retirement, and then you have your home equity, okay? You're making your mortgage payment, you're putting money in there. And then you retire. And what's the first thing you do? You start collecting Social Security, okay? So you take money from there, and then you start drawing, you're required, and after, 70 basically to start.
72.
Thank you. I thought it was 72 because
72.
but
Unless you're already 70 and a half. And then
right, because it's the new law. Yes, the new
law.
law. Thank you. But I called myself, but I figured I'm not going to. Thank you. 72, okay? Then you're going to have to start taking money out, but that's fine because you were planning on that. But then this money is sitting here in your house, and you're not using it for your retirement. And it's a lot of money. We saw it's, $6 trillion, $7 trillion. That's sitting there. And that is the reason for the reverse mortgage to say, look, let's start treating that money in the same way that we treat this other money that you've put aside for retirement. Let's incorporate those funds in your overall retirement strategy. And what's one of the other reasons you want to do that is that this is home equity. This is not real money. This is real money. Okay? Equity, you cannot take it to to pay for your vacation or to buy your car or to pay your bills. Real money you can. So, Equity is not liquid. It's subject to what happens in the real estate market. It's stuck inside the house. You can't get it without either selling or getting another mortgage. And it doesn't help with any of your other investments because it's not liquid. You can't get to it. Whereas cash is all of those things. It's, a reverse mortgage cash, money sitting in a line of credit, you can get to. It's like a savings account. You can pull it out whenever you want. And these other benefits, I'm going to talk about increasing credit line. We're going to get to that. We're going to get to these other benefits in a moment. But you can just start thinking about how equity is not as much of a friend in your retirement as actual money is. So, what is this graph? It's really complicated, but the key here is that a number of economics programs like at Texas U and some other economists, these two brothers, Sachs and Sachs, anyway, they did all these simulations to look at how to use your equity in your home with or without your other investments, right? Or in reverse. So this line shows how long your overall portfolio lasts if you just never touch the money in your house. You just use your retirement funds, you leave all the equity for the kids, and you say, I'm just going to live on the retirement funds. That, you're going to run out of money fastest than if you incorporate your home equity in your overall plan. Does that mean you spend that money first? Maybe, maybe not. Maybe you spend it in conjunction with your other retirement funds. Those are questions to talk about with your financial advisor. But the key here is that by using the equity in your home, and actually, I'm going to explain this line better in a minute, I realize, but by using the equity in your home in all situations, if you use it with your other retirement funds, overall, you are going to have more money longer than if you just leave the money in the house for the kids, don't touch it at all, and just live on your retirement funds. So that is all of the thinking. That's all of the thinking, the background to why you want to be considering a reverse mortgage in your retirement planning. Okay?
So are you saying you can take out, you're given equity at any rate you like,
So we're going to
at
check.
any time you like?
We're going to get right to that right now. Hold on to that thought because that is exactly, that's what's going to be addressed right here. Okay, so what is a HECM reverse? A HECM is a home equity conversion mortgage. It's what FHA calls their reverse mortgage. Okay? And what makes it special? So, FHA has two different kinds of reverse mortgages. They're both very similar, but one is for refinancing and one is for buying a home. I only mention that now because later on, if we talk about buying a home, if you're not thinking about it as two different products, you're going to get more confused because there are some differences that relate to how the mortgage is going to be. Okay? So just tuck that away. Here's a very important thing that you kind of know, but I think it's important to just spell out what is a reverse mortgage. It is just a mortgage. It is a lien on your property like any other lien. You're not selling your home to the bank. You're not giving up any rights to your home. It's a lien like any other lien. You have to be at least 62 years old, and it enables the homeowner to draw out equity from their homes as cash, or for a home buyer to buy a home, but without ever being obligated to make a monthly mortgage payment. All right? That is one of the most important features. That's the most important feature. Then there's a couple of secondary ones that make it really special. Now this also kind of explains how it works. So with a traditional mortgage, how many of you have applied for a traditional mortgage in the last 5 years? Anybody refinanced their home in the last 8 years? No? Okay. Oh, interesting. All right. So if you remember, they decide how much money you're going to get from a regular mortgage by looking at how much income you have and how big a mortgage payment you can afford. Okay? Well, this has nothing to do with mortgage payments, so that part doesn't matter. With a reverse mortgage, we look at the value of your home, how old you are, and what current interest rates are. The more valuable the home, the more money we make available. The older you are, the more money we make available. The lower the interest rates, the more money we make available. And this is all incorporated into a formula, okay? So and I'm going to give you a good example in a couple of minutes, but that is how the amount of money made available is determined. When you have a traditional mortgage, whatever they make available to you on day one, you go, you put it in the bank if you're refinancing, and that's it. With a reverse mortgage, there can be opportunities for more money to be made available during the life of the loan through a reverse mortgage line of credit, and we're going to talk about that in detail in just 5 minutes. Traditional mortgage, you must make payments. Reverse mortgage payments are always optional. Traditional mortgage, what you owe goes down over time. Reverse mortgage, if you're not making payments, what you owe is going to go up over time. Because interest, oh sorry, what happened? Interest and a small insurance premium is getting added to what you owe every year. So what you owe is going to go up if you don't make payments. That is the downside. But the upside is you're not making payments and you've got these other benefits. All right, so now we're going to talk about how the insurance works. Okay, so non-recourse loan. I doubt, does anybody actually know what that means? Is anybody familiar with that term? Okay, non-recourse loan. All it means, a lot of times people get non-recourse loans on other assets like a boat or things. All it means is that the lender cannot go after anything other than the property itself. Okay? So they can't go after the rest of your estate. They can't go after what your children inherit. They can't go after any of your other assets. All they can do when the loan comes due is go after the house. Right? And so that gives them a lot of risk, right? You know, when you think about this, when you think that the loan could be, you could take a reverse mortgage when you're 62, you could take out, maybe $300,000, let's say, bless you. Take out like $300,000, and then you live to be 101 in the same house, you're gonna owe a lot of money. Has the property, the value kept up with that? Maybe, but maybe not. So that means that they could end up with a big shortfall. So what do they do to protect the whole program? They create an insurance fund. And who pays for that? Not the taxpayers, the borrowers. Okay? And so it's a self-funded program, which is why when people are like, oh, are my tax dollars going to keep you in your home? No, you are paying for it in two ways. One, with an upfront and mortgage insurance premium that right now is so expensive. And two, there's a small increase in your interest rate, basically, that also goes to the insurance fund. But how does it work? So I think it's time to get to some examples, because I think it's a lot easier to understand. All right, so the homeowner dies, and they owe $500,000 on their home. And the children want to sell the home because, as we know, most children are going to sell the home that they inherit. So the house is worth $500,000, and you owe $500,000. The bank, of course, is going to get all the money, and the children just walk away. All right, but they're going to inherit everything else that you've left them. Scenario 2: house is worth $600, and you owe $500. And the kids don't want to keep the house. They're going to sell for the $600. The bank gets its $500. Children get the $100,000. That's great.
Is it a basis increase for the sake of taxes for the children?
That has nothing to do with the reverse mortgage. That's going to be the same type of scenario, and that's actually something to talk to Renee about in terms of how you've set up your estate. It's not impacted by the reverse. So, scenario 3, house is underwater. Okay, 2007 all over again, right? House is only worth $400,000. the bank is gonna get the 400,000. But now, where are they gonna get the other 100,000? They can't go after the rest of your estate, they can't go after the kids. They're going to put in an insurance claim to FHA for $100,000. And the children are gonna walk away. So the children, the rest of their estate is not impacted. They don't have to do anything. They can literally walk away if they want the bank to take care of everything. And the bank is going to put in the claim for $100,000. So if you've had, used up to potentially $500,000. Okay, there's interest in there, whatever. But you've had use of all this money, but you're not paying back $500,000. You're paying back the $400,000 because that's all the house is worth. And the bank puts in a claim to FHA. Now, what if the kids want to keep the house? All right, so house is worth $600,000 and you owe $500,000. They're going to do exactly what they would do if you had a mortgage, a regular traditional mortgage, right? You can't just walk away from a traditional mortgage. If you leave a child a house that has a mortgage on it and they want to keep that house, they're going to have to refinance or pay off the mortgage. So they're going to pay off that $500,000 and keep the house. But what if the house is only worth $400,000? And the kids are saying, this is crazy. We really want to keep the house. It's on a lake. It's beautiful. It's, the house we grew up in, whatever. But how can we possibly justify spending $500,000, getting a mortgage for $500,000, which we can't even do, on a house that's only worth $400,000? So if it is an heir or beneficiary, they can refinance for 95% or use cash, 95% of the market value of the home. So in this case, that would be $380,000. You can absolutely get a mortgage for 95% of the market value of a property. And now what's going to happen is the bank is going to put in a claim to FHA for $120,000. So again, the estate is clear. The children are never overpaying for the home in terms of market value. They can keep it, they can sell it, and how is this all possible? That insurance policy that no one wants to pay when they close. Now here's an important thing to know. When you close, most borrowers are going to finance the closing costs through the reverse mortgage. So it's not like you're walking in with a check. The only time that happens is if we're helping you to pay off a very large mortgage, and sometimes it's worth it to come in with the closing costs or to come in with a little extra money so we can get that off of your plate. But generally speaking, most people finance it, so they're not even spending it themselves. The house is going to pay it, and that's what makes this program work. Because frankly, if you think about it from the lender's perspective, if you can loan money and be guaranteed that you're going to get the rate that's on that loan, and you're going to get paid back, at some point in the future, but no matter what, it's a variable rate mortgage, which we can talk about, but no matter what, you're going to keep up with current interest rates, and you're going to get all of your money back one way or the other. You're happy to loan that money. And that's what keeps the whole reverse market going, okay? All because of this insurance policy. So it's a win for the banks, the lenders. It's a win for you because you don't have to worry about the rest of your estate. It's the same thing if you want to move cross country. Let's say it was 2007 and your kids are living in California and you're living here in Massachusetts and your house has taken a big hit on property and you were really looking forward to selling and moving out to California to be with your new grandchildren. And then you say, we can't afford to sell. We have a mortgage, we have this, that, and we're going to take such a hit on the property that we can't afford to sell, because maybe we owe too much. Well, if you had a reverse mortgage instead, maybe you wouldn't have the capital gains to go and move. Maybe you're underwater, but you can at least just pick up your estate and move and not have to be locked in because the property is underwater. Okay, so that is a critical thing. So now we talk about what I consider to be the most interesting and most fun part of a reverse mortgage. And then I'm going to stop and take questions and just mention some of these other things.
Well, one question
Yeah.
about that scenario.
Yes.
The federal taxes of selling a house for the children. No taxes?
No taxes meaning because there's no capital gain? That's gonna be related to the basis of the house.
Right,
So-
has the reverse mortgage doesn't affect your taxes the same way a traditional mortgage will not affect your taxes. Your capital gains on a house sale go solely with your basis plus your improvements and your sale cost, and a mortgage is never in the picture.
So when you normally die, your basis for the inheritors
Correct, steps up.
turns out to be 0 at the time of your death.
That's correct.
Now, is that true if you have if you're monkeying with a reverse
Yes.
mortgage?
Yes, the reverse mortgage does nothing to change any of that.
Right.
Neither for the positive nor for the negative. It is completely neutral because it's just like any other mortgage. Okay, so what I've heard some people say is that when they retire, they take a line of credit out immediately so that they have funds available from their house, which in theory is kind of like a reverse mortgage, but it has a lot more problems than a lot of people realize. When you go to the bank and you get a traditional line of credit, okay, 2007, I'm sure Renee saw cases like this where people had, if you don't know, Renee's a financial advisor, so I'm just letting you know, and she's fantastic. So if anyone has questions on that stuff, you should talk to Renee. People who took out lines of credit so that they would always have cash available, market goes south, your line gets frozen, it gets called, it gets reduced, what you can draw on. You have your own personal significant change in income, like you took the line of credit when one spouse was still working and that spouse passes away, your line of credit could be frozen, reduced, or called. So that line of credit, it does not guarantee you access to the home equity in your home for the rest of your life living there. It only guarantees it basically for 10 years or unless something bad happens that you have no control on, okay? So that's one of the big risks with a traditional line of credit. The other is that the minute you start using it, you're going to have to start making a mortgage payment. And I'm surprised I didn't have a slide in here saying this already, but one of the key, because I thought I did, one of the key things, the big benefit of a reverse mortgage is cash flow. Okay, what do we all worry about as we get older, as we get retired, is cash flow. Even when you have a good amount of retirement funds, you're still worried about how long it's going to last, how quickly you're going to go through it, how fast you're going to draw it down, and so you're thinking about what your monthly payments are. A week like last week, you're thinking, oh my gosh, I've got to pull back on how much I'm spending because now I've got to wait for my funds to recover from the market last week, right? Or this week now too, all right? So the one thing you don't want is a new monthly payment, which the minute you take out $10,000 from that line of credit or $1,000, you're going to have to start making a payment. It's going to start as interest only. But in 10 years, it's going to be bigger because now you're going to have to start paying principal. If interest rates go up, it's going to get bigger. And all of this is while you're trying to keep your cash flow consistent and as low as possible. And this is what I'm saying also, your payment size is also going to go up as you get older, which is exactly what we don't want. We don't want more bills or bigger bills when we're in our 80s than we had when we were in our 70s. So, the reverse line of credit, what happens is we decide how much money is going to be made available. And actually, I'm going to skip. Well, no, I won't. Okay. So we decide how much money we're going to make available on day one. And if you don't need to take that all out in the first year or two, it's going to sit in a line of credit. Let's say we make $300,000 available in a reverse mortgage, and you don't have a mortgage. Okay, so there's $300,000 there right now. You can't take it out all at once. You can only take out 60% in the first 12 months, and then after that you can take out everything you want. But let's say you say, no, I'm not going to take it all out. I'm going to let it sit there until I need it. Well, number one, no matter what happens to the market value of your home, no matter what happens to your personal situation, if your spouse passes away or something else happens, as long as one of the borrowers is still living in the home as their primary residence, that nothing changes on that line that's available. They don't come back and reappraise. They don't change it based on your income situation because we never cared about that in any big way before. So it can never be called, frozen, or reduced. You never have to make a payment. You take out $50,000 today, and you don't have to make a payment on that if you don't want to. If you want to, you can. If you don't want the interest to grow too much because you think your kids might want the house and you don't want the loan amount to be too big, you can always throw money in as interest, but you're never required to. And if you do put money in, that money also gets credited to the line of credit, and you can take it back out whenever you want. And the interest payments, you can make the payments, you never have to. And if you do make a payment and 3 months later you go, oh, that was really dumb. I really could have used that money right now because the car just died, and I really wish now I had that $10,000 that I sent in as an interest payment. It's sitting in the line of credit. You just send in a little form and it gets sent back out to you.
So is the interest rate variable?
It is in order to get this. In order to get most of the benefits, there is a fixed rate available. It does not have a line of credit. It's really for using to pay off a very large mortgage or a fixed rate, or sometimes if you're using the reverse for purchase, you might want to look at the fixed rate versus the variable. But if there's equity that you're going to want to be able to tap in over the life of the loan, then you take a variable. And the variable right now it's been tracking pretty close to slightly higher than the 30-year fixed, but pretty close. So right now it is under 4. The variable rate is starting, I believe today's like at 3.8. It has a 5 points cap, meaning over the life of the loan, it will never be able to go over 8.8, okay? It can never go up by more than 2 percentage points over in any given year, okay? But it is a variable rate. But here, I'm going to skip and go. I'm going to go right to here. Okay, I'm going to go right to here because I don't want us to run out of time. Here's the important thing though. Whatever the rate is that we're charging you on your loan balance, we are going to release equity to you on an annual basis related to whatever we've made available in your line of credit. So in other words, that was such a confusing thing to say. I'm really sorry. What does that mean? It means that let's say you start off with a line of credit of $223,000 and your interest rate is 4%, okay? And we're just going to pretend it doesn't go up at all during the last one for this example. $223,000 every year that you don't use that line, we're going to add 4% of $223,000 to that line. Okay? So the line of credit that if you don't touch it, it continues to go up. Now, what if you want to touch it? What if you take out $23,000 for a car? Okay? Took out the $23,000, the other $200,000 is going up by that interest rate. Let's say interest rates go sky high and you are at your cap. You're paying 8% on whatever you owe, or at least that's what's growing, right? Your loan balance is being charged 8%. This line will also grow at 8%. So any money that's sitting there is going to grow while it's sitting there. Okay, if you bring this down to 0, you spend it all out, then nothing. Okay? But if you made a payment, it starts all over again. So this is a good example. So in this case, you have a home value of $600,000. You owe $62,000, and so let's say we only made $223,000 available in this case. It would actually be more now because the interest rate's being down so low. But we made $223,000 available, and you're like, oh, it's $223,000. I could go to the bank and get more than that. Like, why is this good? Well, no payments. Okay, you leave the money sitting there. You let it sit there for 25 years, your home value has gone up to, we're assuming 4%, because that's the national rate right now. So this is just an example. Your home value could go up to over $1 million. Okay, in this case, it's $1,024,000. But the line of credit that you have available is actually $1,026,000. It is possible to have more money available on the line of credit than even the value of your home, and they still don't come back and readjust it. Now, I will tell you, this is how it works in theory. The ability for most people, or the desire for most people to just have that money sit there for that length of time doesn't typically happen. But it used to be that this line crossed at the age of 79. Yeah, 76. And they said, oh, too many people are starting to find this a little too appealing. So they changed the formula, so now it doesn't happen until the age of 89, because it was starting to look a little too attractive to like financial advisors and stuff. So in theory, it can happen, you could do it, but that's not the purpose for doing a reverse mortgage. The purpose is so that if you start off with $223,000 today, when you're 62, and you're thinking, what am I gonna do for long-term care? Maybe you have a health reason that you don't qualify for a long-term care policy. Maybe the premiums are more than you feel you can afford, okay? You start up the line of credit, and you think about the growth of that line of credit over 15 years, when you might need long-term care, or 10 years. Now you've self-funded your long-term care. Or you've taken out the money, and maybe you've talked to your financial advisor, and they now are recommending that you use some of the money you've saved to buy a long-term care policy, or something else. So that's just an example of how the insurance works.
But
The line
it's
of credit.
still a loan, and you are paying, somebody's paying interest on it.
Not you, your house and
The
your children.
bigger the size.
It's not free money. That is true. It is not free money. It is going to get paid back eventually. It's going to get paid back when you leave the house. If you're in the house until you pass away, it's not going to be out of your pocket. It's going to be from the house. That's going to, not even the rest of your estate. It will be the house that pays back. If you do sell, then it is coming out of your pocket. But it is money. If you are worried about the loan balance getting too big, as I said, you can always throw an interest payment in, because that's really the only other expense that's different than a traditional mortgage, right? It's just the accrual of the interest.
And if the house value doesn't increase and goes down,
You won, because you have bought a put on the value of your home. That's where the reverse mortgage is even more attractive, because you have gotten access to all of this money in your house, and you don't have to pay it back, because it's going to be the insurance policy that pays it back.
but the children get money.
Well, the children weren't going to get much anyway, because the value went down. Right? So that is like where something like a light bulb goes off, and you realize it's actually a put on the value of your home, if you know what I'm talking about. You're buying protection on the value of your home. You have made all of that equity available to you, and it is now no longer impacted
But
by the
if you
value.
if you don't spend all the equity on your home, then
You don't pay interest on the money you don't
the
use.
more you sort of spend in terms of partial, the less the children get, because you're paying interest on it.
You're only
So the
getting charged
equity in
interest.
the home decreases.
You're only being charged interest on what you use. So if you're using the money, there's going to be interest.
Yeah.
So that is no matter what. But if you had a traditional mortgage or a traditional line of credit, you would have had to pay that interest out of your pocket, and then the value of the home didn't keep up with it. So that money you paid out of your pocket could have been money that you handed to your kids now, and let the house worry about whether or not it has the money to pay back the loan later.
And just to add to that, it's possible that by doing something like this, rather than taking, so you have your minimum distribution, your RMD on your IRA, which is taxable income. You take your RMD, but you don't take anything more than that, and you use the money from here. So now your kids have an IRA, they can, under current law now, stretch that out for 10 years once you've died. So it's possible that you're leaving more to them in IRA, 401k type money, rather than this.
However, if your money in your IRA has run out,
Well,
and you're
that's-
thinking of a reverse mortgage
Right.
to stay in your house, then you,
What's the downside there?
then the downside is there's nothing left for your children.
But
That's
where
true.
would your children like to see you living? I mean, it's a weighing game, but
That depends on your children, and then that depends on you.
that's
That's
true.
These are decisions that one has to
That's
think
true.
about.
Absolutely, and those are all things to be talking also about with your advisor, but it gives you a whole nother option. For instance,
Oh, see, I didn't know that slide was coming.
yes, but exactly, and that's why I skipped ahead. You know, this is the problem when my preference is always to schedule this for an hour and a half, but sometimes the centers need it to be an hour, because there are so many different, once you get like the basics down, then there are all these interesting pieces to know. But this is exactly what Renee was talking about, which is, if you just have your IRA and you start off with $1 million, now these numbers, in this case, they're using an 8% draw because it's 2% goes to taxes and then you're getting the other 6%. If all you did was look back, and I can run this with any percentages anyone wants, but if all you did was look at the 4 bad years in the market, and actually, and you see what happens to that IRA over the 20 years, you're left with, after almost 20 years, it's 18 years, you're left with $106,000 for your children to inherit, okay? Now, if instead you set up the reverse mortgage, okay, and you took out the money that you were going to take from your IRA, instead, during those years, you took it from your reverse, and it says 64 instead of 80 because it's not taxable, because it's loan proceeds. If all you did was take out that money just in the bad years, just like a week like last week when you were going to take a distribution, if instead of taking it from the market and destroying the growth value of your IRA, instead you took it from the house, your IRA at the end of those 18 years would still be worth $1 million. And for your children, after they paid off what you owed, if you died then, instead of getting $100,000, they would end up with $440,000 because you've almost $450,000 after you've paid what you owe on the reverse mortgage and what is left. That's the difference. 4 times the value what you're leaving to the kids by using the reverse mortgage just to protect your assets in a down market. So it really does have some very significant financial benefits for people who have retirement funds, and for the person who doesn't have significant retirement funds, it's all about having the cash flow to remain in your home. It's all about not having, and one thing I do want to mention is, especially when you're thinking about potential widowhood for one partner or the other, your Social Security check, if that's your only income, it's getting cut in half. If that's a significant part of your income, it's getting cut substantially. One check is going away. If you have a mortgage that you've been paying with that one check, say, oh, we're good. Like, I'm just going to use this check, the smaller check, to pay the mortgage. We're going to use the other check to live on or to supplement our income to live on. Now one check has gone away completely. Instead, you have the reverse mortgage set up. You don't have a mortgage payment to worry about. That cost is not changed. You're not spending money on a mortgage payment that you no longer have. So it is 12 o'clock right now. Why don't I stop? I want to make sure I answer. Let me go over those questions. I do want to say that some of the important things, so there's a reverse mortgage to buy a home, which enables you to also have more money left, long-term care, and tax purposes that we were just talking about. But I wanted to just say, so these are really the key things. There's issues related to Medicaid. There's issues with being able to delay Social Security, cash flow, retirement, buying a new home. I am happy to stay and talk about any of this stuff, or we can all stay and talk about more, but I just want to put all those things out there. But questions that you have. Can it be to refinance a vacation home? No, because it's not your primary residence. But you can take it on the primary residence and then use that money for whatever you like, including buying a vacation home. Okay? Can it be used on a mobile home? Yes, depending on there are certain criteria that a mobile home has to meet, but they are not excluded from reverses. So it can be a mobile home if it is the primary residence. Going into a retirement home. So you don't have to sell right away, but basically within that year, you're going to have to make a decision if there's a reverse mortgage on the home. You can use a reverse mortgage to buy in a senior community where the homes are either single-family homes or PUDs, like where you get these developments where there's some shared space, but it's not a co-op, it's not where you're buying a share, like a senior assistant living kind of place. Those won't work. But if you're buying in like a senior community, those usually can work.
So you can't use it to buy into a continuing care community?
Correct, because there's no deed.
Oh. Okay.
There's no deed. So it's like a co-op, you're buying into a corporation, you're buying into something, but you're not actually owning specific property that they can foreclose on. So, but you can use it for condos. It does get a little bit more complicated because the condo has to meet certain FHA criteria. And we can help the condo complex get the appropriate approval. So it does make the process a little trickier. Not all condos can meet it, so that's something for us to talk about, and I actually get the documents from the condo association, and I can tell someone whether or not they're going to be able to get a reverse mortgage. But like these retirement communities where you own your home, but there's a shared maintenance fee, for the community center and for them to provide different services, that's fine. That definitely can work in standalone homes or townhouses are all fine. You can even get it on a multifamily, okay, if you're living in one of the units. All right, so you can have a multifamily home. You can have we don't even care who's living in the other unit, meaning you could have your kids living in one unit, you're living in one unit, maybe if it's a two-family, that's fine. So, you're able to keep that home going, but not for investment properties. You can take the money out and buy an investment property to get rent, but you can't get a reverse mortgage on an investment property. We talked about the fees, we talked about the insurance. So, other questions, or if there's anything that anyone would like to see me talk more about? You came in late, did I give you enough information?
Well, it went so fast. Is there something we can read with all of this in it?
Yes, there is. As a matter of fact, so I have some folders with some info, and let me just pass these out.
Thank you.
Brenda, do you want one? I have one. Okay.
Last time we met.
Yes, I thought so, but in case you wanted one for a client. Okay.
Actually, you know what? Yeah.
Yeah, I'll give you one. Yeah. I'll give you two, Renee. Because I like you. And also, there's two books that I'm happy to provide to anyone if they give me a call. I only have one copy of each with me. This is about. Okay. Let me take down your information before you leave, and we will mail you one. Okay. This one is specifically for borrowers. It's a much easier read and explains the pros and cons. This is more about for financial planning, okay, which some people really enjoy reading as well. This is written by an economist. So I'm happy to have my assistant send anyone a copy, and I can, here, as a matter of fact, why don't, since you have your pen out, why don't I give you my pad right now? And you can just give me your name and address, and Linda will send you one. Any other pieces of this that you would like me to talk about anymore? Because it's a lot, but it's really interesting stuff, and it really makes a huge difference for a lot of people. Although, not for everyone, so I don't want to, this is not a sales pitch, I mean, it's an education moment, so, but it really is a much more interesting product than most people realize, I think.
For the purchase of a home, how much of a down payment do you need to put down?
Generally, it's 50%. The older you are, the less it is. And let's just go back to March. Okay. So in this example, March and Homer are 62. They're selling their current home for $600,000. And earlier in this example, I show that they owe, I believe it's $135,000, $140,000 or something. But anyway, after they've paid that off and paid the broker's fee, they have $450,000 left. They find a place that they love for $400,000. Because they're so young, in this example where interest rates were when this was put together, they had to come in with $220,000. Today it would be a little less because interest rates are lower, but if that changes next week, it's back up to here. Okay. So from this, they put down $220,000. They get a reverse mortgage. They never have to make a payment again if they don't want to, and they have $230,000 left to add to their retirement funds or to do with whatever they want.
That is less these costs of,
That's after the cost. Yes.
well, they're not gonna have 230,000 left.
Oh, that's true. Yes, that's true. Because that includes in this 220.
Yeah.
This 220 included the cost. Okay, because the home was 400.
All right,
200,000, and basically in this example, it's 20,000 for the closing costs. That's how they end up with the 230. So that does include all of the costs. It includes the broker's fee, it includes the closing costs on the mortgage, everything. Now they could have instead bought a home for $700,000. We would have given them 350, okay, 50%, all right? And they would have had less money in their retirement funds, but they could have a $700,000 home if they wanted to. You know, if they decide they want to retire to some, you know, this is it. This is going to be the last home we buy, and we want the home of our dreams that the grandchildren love to come to. That's the way to do it, because I'm sure that Renee would tell you that if they walked in and said, we're going to have $450,000 left, what do you think about us taking out, $250,000 from our retirement funds to buy the home of our dreams? I think a lot of financial advisors would like choke, okay? Instead, they would have $50,000 additional retirement funds, or approximately, and have the home of their dreams. Okay, so it's a pretty important difference. So that's how the reverse mortgage works for purchase. Okay. Did people? Okay. So any other questions? So in your folders are my business cards. There's at least one, probably two. I'm happy, like I said, to send books. I have more cards here as well. I'm happy to send books. I'm happy to answer questions. My office is in Brookline. I travel throughout the state, and actually I travel throughout New England. So anything, and I usually what happens is if there's someone who wants to meet and really talk about it in depth, we usually have a face-to-face meeting. People either come to my office or I come to their homes, or we meet at some place nearby that someone would like to meet at. And we walk all the way through all of this with specific numbers and how it would work or not work, for individual people, and I just let people know exactly.
And there's a fee for talking to you, or
No.
it's covered by the
There's no fee.
For the mortgage company, so to speak.
Yes, it's covered by the mortgage company. Just like a traditional mortgage. I hope no one has ever paid money to be with a traditional mortgage lender. There's no fee, there's no application fee. What you are on hook for, when you apply for a reverse mortgage, there's no cost. You do have to pay the counselor when you meet with the counselor. That's an independent person. Generally speaking, they're about $150. Some are $125, some are $175. There are not a lot of counselors in Massachusetts. And Massachusetts passed a law requiring you to meet face-to-face. Most of the other states, you can do it on the phone. There's some nice things about doing it face-to-face, but the downside is that because there aren't many counselors, you have to travel sometimes to get to that. That's usually an hour and a half meeting, and you have to almost always pay them at the time of the meeting. Then the other place that you could run into an expense is you've met with the counselor, you've signed the application, okay? Now we're ready to order the appraisal. We order at any point, you can stop the process. You can say, you know what, I've changed my mind, just stop right now. That's fine, okay? But if the appraiser has walked into your home, and if all they've done is walked into your home, you're going to have to pay the appraiser no matter what, because they are, again, a separate company. But until then, there's no cost. At the closing, unless you owe a lot of money that's going to require you to come in with some money, there's nothing out of pocket to the borrower. And then you have 3 business days after the closing to again say, you know what, I changed my mind. And then it will all be canceled, and anything is refunded except the appraisal and the counselor that they pay directly. We're not trying to catch you. It's all if it works for you, then I love to be of help. And if it doesn't work for you, we're not going to take you over any coals or something, whatever that saying is. But, if you would like to, do you want me to see
Sure.
in a second?
Yeah.
All right, well, on that note,
Great. Thanks.
I would like to thank you all for your time. I hope that this was helpful. I know it's a ton of information. And that's why it's really important. What I find is that people walk out of here feeling like they understand it a lot better, and then 2 days later someone asks them a question about it, and then they can't, it's like, oh, I can't really explain it now, but I know I understood it then, because it is a lot of new information, and it's not the way we are accustomed to thinking about mortgages. So that's why if all you want is like you want a refresher answer on something, just give me a call, and we can walk through any part, and we don't have to meet or anything, just give me a holler. Okay, or send me an email, anything. Thank you all very much, and I look forward to talking to you all again.
Thank you.
Oh, you're very welcome.